So, how about that non-farm payroll report? What a doozy. It sounds like I'm joking because, I mean, there are a few things that sound less exciting than reading the non-farm payroll report, but it is something that I look forward to every month. It is important to know how many jobs were either created or destroyed in the U.S. economy. That, of course, is going to impact the Fed's decisions on whether or not to hike rates. As all of the wizards of smart, all the Wall Street economists and all the big banks are anticipating, as Jerome Powell has been trying to forecast. But when you look at the NFP data, hard to see Powell hiking rates. Now, the ADP report, which came out yesterday, was like double expectations at like over 800,000 jobs were created on net in the month of December. That's what we were told. But too bad, ADP is always wrong. Whether ADP way overestimates or way underestimates, it's a great counter indicator. If the ADP report looks really good, you can be guaranteed that the NFP report, which is the official government data, which comes out on Friday, is going to be terrible. And that's what we got. ADP was over 800,000. Non-farm payroll report, under 200. 199,000 jobs were created. It was estimated by all the wizards of smart that it was going to be 447,000. That was the aggregate number of all the estimates of all the smart economists on Wall Street who were surveyed by, I think, Reuters does the estimates. And it's not shocking. There haven't been any stimmies doled out in quite a while now. So I would not expect jobs to be growing. The job growth that we've seen has, over the past 2 years, since the initial shutdowns, has been fueled largely by stimmy bumps. People getting their stimmy checks and getting welfare and going out and spending it, and creating a bunch of artificial demand. And so when you've got West Virginia Senator Joe Manchin arguing with his party and balking at more stimmies and more government spending, the result is a slowdown in economic growth, because we don't have any real economic growth. All we had was growth in government spending. The U.S. economy is addicted to monthly or bi-monthly, I would say, or at least quarterly trillion-dollar injections in government spending, the way that our bodies are becoming addicted to quarterly injections of Wu flu vaccine booster shots. You go 3 months without a booster, all of a sudden, oh, gee, my immune system's not working anymore. It's not fighting off the virus. Time to go in for a new booster. That's the way this economy is when it comes to trillion-dollar stimulus packages, multi-trillion-dollar stimulus packages. In fact, the longer we go between these injections, the bigger they have to be. Growth is now decelerating visibly. And so do you think that the Federal Reserve is going to be hiking interest rates in this kind of an environment? Do you think that things are going to look better or worse 3 months from now from the Fed's perspective? Things are going to look worse. Right now, I guess the reason why folks are pricing into the bond market all of these rate hikes that the Fed has not put into effect yet is because they're looking at the unemployment rate. And yeah, the unemployment rate is low, but the unemployment rate right now, this low unemployment rate, is a factor of labor force participation. It's not a factor of employment. Employment is quite low, but because labor force participation is also really low, the unemployment rate, meaning the percentage of people in the labor force who don't have a job, is also quite low. But it's just there's a massive percentage of the population, approaching 40% of the American population, that is not in the labor force. And where I live, the labor force participation rate, is almost I think it's in the high 30s where I am. In my town, if you have a job, you're in the minority. And that's true for much of the country. If the average for all of America is in the low 60s, approaching 60%, that means that there are a lot of communities in this country where a majority of the population doesn't work. And so do you think it's possible to have a healthy community under those circumstances? I can tell you in the case of where I live, I'm in Florida, there's a lot of retirees here. The difference, the gap left by the people who aren't working is made up by capital gains, by people who have wealth generated from the Fed inflating asset prices. That's true for America in general, but it's particularly true here where we have such a small labor force. And so this is something that your local labor force participation rate is something that you should look up and research in your town. If you're in a town where labor force participation rate is like over 70%, you won't have as much to fear from a stock market or a bond market crash or a real estate market crash as, let's say, someone who lives in a town like I do. Because asset price appreciation is a much smaller factor contributing factor to a consumer demand in an economy where you have a higher labor force participation rate, where people's demand as a consumer is a function of their own labor. If the stock market crashes and nobody owns stocks, it's probably not going to affect you. But if you live somewhere like in many of the communities across the country, like mine, where a majority of the population isn't working, they're living off of these capital gains and asset price appreciation and savings and all this. If their asset prices crash, that is going to be a huge blow to consumption within our local economy, which is bad if you are, like in a service industry or something like that. And so that's why the unemployment rate is so deceiving. I think most people understand that at this point, that the unemployment numbers are rigged, but they don't necessarily understand to what extent. They still generally, if they hear, unemployment is below 5%, they think, wow, that's incredibly low. It is a very low number, but the unemployment rate as currently constructed just does not give you, it's not useful. Because unemployment might remain unchanged, but if we have a stock market plunge, let's say stocks went down 20-30%, that an economy with a low labor force participation rate is going to be it's going to get kneecapped severely. And then you'll start to see the unemployment rate start to react. And so don't expect the Fed to raise rates just because unemployment is low. I don't want to give the Fed a ton of credit. I don't give them very much credit at all. I think that they are incredibly insular and they're not smart. I'll put it that way. I'm not going to come up with any fancier language than that. They're not intellectually curious. I don't think that they think as hard about this stuff as most of us outsiders do. But even with respect to their own self-interest, they're going to intervene and halt any potential rate hikes if it means saving the stock market. I don't think that the Fed is going to... I don't think the Fed thinks in their head, hey, the stock market goes down, this is going to be so terrible for the economy. Well, maybe they do. But I think it's more of a self-interested thing. Everyone in the Fed and everyone that people in the Fed know, they all own stocks, and so it's very personal for them. But I think, to a certain degree, the folks at the Fed must understand that the asset price bubble that they created is what has been holding up this Potemkin economy for over a decade now. And so even though they claim the unemployment rate is what they're looking at, and folks are pricing that into the bond, into bond prices, because the non-farm payment report that came out today, unemployment rate looks great. If you just look at the headline unemployment rate, wow, this is great, very low unemployment, and so bond yields surged up to, I think I saw that the 10-year was like at 1.78% today. I did not look if it got any higher, but that was just one number I saw. I mean, we're getting close to 2%. This is ridiculous. I don't give investment advice. I'm not a trader. I would never engage in trading. But to me, this is a pretty clear example. I mean, I don't know when the best time I'll get in will be, but it's if you're looking to get into the Treasury market, this might be a good dime, because they're pricing in Fed rate hikes that simply are never going to happen. The more that bond yields rise, the closer the stock market gets to a cliff. And if bond yields keep going up, if the Fed allows bond yields to keep rising because there's this expectation that the Fed is going to raise interest rates that much, they're going to push the stock market over a cliff. And we're already seeing, the labor market peter out, as I said with the NFP report. It's abysmal. It's pathetic. If this really was such a great labor market, you would see the labor force participation rate ticking up a lot. You would see people piling in, wanting to get jobs. There's help wanted signs everywhere, but there's nobody who wants to work. It's not enough to coax these unemployed people back into the labor force. Why? Well, where I am, the jobs that you see that everybody's hiring for, you're not making enough to live here. Rent is absurd. You're looking at close to $2,000 a month for, a normal apartment. If you manage to find like a studio or something, which they're only putting in these brand new buildings, because there's never been any demand for studio apartments in this, I don't live in an urban area. We don't really have dense urban centers in Florida. We just have, essentially all of our cities are built like suburbs for the most part. Everything's really spread out. We don't have tall buildings. We're now starting to build a lot of tall buildings because despite all that, things are so expensive right now that the only place to build is up. And even then, you're paying $1,200, $1,300 a month for a studio, if you can get one, because they're in very short supply. And to be at the bottom of the rental market, you're going to have a lot of people piling in. You just can't afford to live on what these jobs are going to pay you. And it's showing in the quality, like when I go out to restaurants, for the most part, not only are they severely understaffed, but there's a lot of really green people. You don't have experienced servers and cooks in there. Places that I've gone my entire life, I go into, and the food is just not well prepared. They clearly have somebody back in the kitchen who doesn't know what they're doing and has not been properly trained and just doesn't know how to make the food that restaurant has been making for years. And you've got these young servers who, definitely live with their parents, who are not, they're not the chain smoking experienced waiters that, you're used to. They're young kids who wanted to get a job and got one. But it's a lower class of people that you're dealing with. I mean, I remember just a couple of years ago, even if you went to a drive-through place like Taco Bell, or McDonald's or something, you had pretty professional staff. People who were there, who were longtime employees, you get used to seeing at these places. They had pretty low turnover rates. I mean, and that stuff is all gone. So there's real, and these are obviously just silly little anecdotes. Obviously, having to wait a little longer at a restaurant is not to say that, oh my gosh, I had to wait, an extra 10 minutes for my hamburger, so therefore, the economy's in shambles. No, there's examples like this with every industry. Things are not going well, people are not doing well. And the Fed is not going to be able to continue that fiction for very long. Things can get ugly fast. Risk happens. And so, no, we will not see 3 rate hikes in 2022. Governor Brainerd, or no, not Brainerd. Who was it that said it? I can't remember his name now. I can picture his face. He's the St. Louis Fed governor, I believe, or maybe they moved him somewhere else. I'm pretty sure he's still a non-voting member of the Board of Governors. But, suffice it to say, the Fed will change their tune. The bond market is pricing in too many rate hikes. And that, of course, unsurprisingly, is killing growth stocks. You're seeing a flight to quality, unsurprisingly. Any upward tick in interest rates is going to kill all of these unprofitable tech stocks that are, their whole long thesis is, well, they're growing and nothing else is. I think there's a whole generation of people, probably anyone under 40, they look at the S&P and the Dow and they say, why would I ever buy that when the NASDAQ always goes up more than the S&P and the Dow? And that's because NASDAQ, of course, is all the shiny, techy growth stocks. It's because, people my age to, probably 15 years older than me, they don't know what rising interest rates look like. They've not been through a real Fed tightening cycle. Powell babied this generation. He babied, of course, the boomers, who want to get through the rest of their lives without having their stocks ever go down. They want to be dead before the stock market ever goes down, because the boomers won't let go of anything. That's why they still control Congress and the White House. Although I guess Biden is so old he's considered a silent, isn't he? Actually, no, he's not. I think Biden is a boomer. I think he was born after 45. But all of them. The boomers don't know how to let go. They were a generation of coddled children who were, they grew up with the peace dividend of World War II. They know nothing but extravagance and excess. And I think that is a big reason why this whole, no recessions ever mentality, the economic equivalent of the zero COVID policy has been, allowed to reign, and it's going to end so much worse than it would have if they'd let things come apart properly in 2008 or 2018 even. The boomers think that they can go the rest of their life without any more economic strife. They want to leave it to people my age and older, everyone younger than them. They want to leave it to everyone age 60 and younger. Let them deal with the economic complications of their whole 80 or 40-year reign. Hell, it's been more than 40 years now. The bond market bottomed in 81. So, we're in the 41st year of this nonsensical experiment. And Powell does not want it to end. The fact that he accepted that second term, to me, shows that he thinks he can make it through another 4 years without recession. Because the way that Powell flip-flopped back in 2018, I told you, he will not allow a recession under his watch. He doesn't want that on his conscience or his record. He doesn't want the friends at the golf club to, tease him about it and to say, hey, my portfolio took a hit while you were the Fed chair. Why didn't you stop the stocks from going down, Jerome? He doesn't want that. So if he's going to stick around for another 4 years, it means that he's delusional enough to think that he can skate by like this for another 4 years. These are the behaviors he's going to continue for that entire period. The economy is much worse off now, unquestionably, than it was when Jay Powell was hiking rates back in late 2018. One last note, though. I hope bond yields keep rising. I hope interest rates rise. I hope that stocks, bonds, and real estate all crash. It needs to happen. Things need to be cheap. I'm one of those people in my area to where it's, and this is true across the country, cost of living is untenable. I refuse to live like a pauper for the rest of my life in order to protect the portfolios of the baby boomers. So with that said, I will see you folks back here tomorrow.